Good morning. First of all, I want to say thank you very much for everyone that has joined. This is our first annual economic update. We've not done one like this before, but this is the first time. So one of the things we do for CBC is to add value to our customers by providing you, I'll call the domain knowledge that our in-house professor, we call it Professor Yoon, has prepared along the way. He does that for us once a week. He does it on Monday. But I felt, why keep good things under the wraps under CBC? So we thought we'd have it presented to our customers. So I'd like to keep this as interactive as we can. I think there'll be time at the end, question and answer. Hopefully we'll leave it and it's in the chat. So you can either send it to the chat or you can raise your hand. We'll be able to do that. So if you want to just get started, Mark, I know it's about an hour time that we have. We are very grateful and humbled by the fact that at least 75 people have joined us, and we'll have more people joining as time progresses. So we'll keep this going, and in the interest of time, I'll give it to Mark. He has done a lot of work. So first, I want to give credit to Mark, such a hard work that he had done over the weekend and last 3-4 days and last 3-4 weeks. He's been spending time trying to get the deck ready. So I know it's 10:02 right now, and I'd like to give it to Mark and introduce the packet that he has for the economic update. We've heard this, we've seen this, but this is our first time we're doing it with our customers. So hopefully you'll find this valuable. And if there's other questions, you can follow up with any one of us. We'll leave our contact information at the end of this so you can reach out to us and have a conversation about what does this mean, what does that mean. I'd like to see if there's a running chat that can go, so there's questions as slides get presented. If there's questions, then we can have Mark address them at the end. So we can continue to do that so that we can gather all the questions at one time and then have them addressed towards the end. So without any further ado, I'll give it to Mark. Mark? You're on mute, Mark.
Okay. Do you see my screen here, right?
Yes, we do. Yes, we do.
Okay. Great. All right. So good morning, everyone. I really thank you for joining us today. We all know we're in a pretty interesting and turbulent time right now, and economic uncertainty is still very much in the air. And from shifting trade policies to changing consumer behaviors and to geopolitical issues, I mean, there is a really lot going on. My goal today is to walk you through the latest economic data that we're seeing and share some, insight, timely and clear insight that can help you navigate these challenges and make informed decisions. Okay, so I'm going to walk you through 9 key areas that are shaping our economy. I'll cover, first of all, Trump's tariff and stock, bond markets, and commodities, economic growth and employment, and consumer activity and confidence, inflation, manufacturing production, housing, and interest rate cut expectation and forecast. Now, I know that that's a lot of ground to cover. Yes, there will be quite a few numbers, but don't worry. I will break things down clearly and wrap up my presentation with a quick summary of the key takeaways. So let's dive in and take a look at what is really happening in the economy. The first topic is Trump's trade policy, which has contributed the dominant impact to the economy. Now, let me give you a quick rundown of Trump's recent tariff timeline. As you're aware, it all kicked off on February 1st when Trump launched what many are calling Trade War 2.0. When he signed executive order imposing new tariff, 10% on Chinese imports and 25% of goods from Mexico and Canada. The justification, national emergency tied to illegal immigration and the influx of fentanyl into the United States. Now, fast forward to early March, and we saw even more tariff roll out against China, Mexico, and Canada. Then on April 2nd, the big day, the Liberation Day, Trump made a big move. He announced a sweeping 10% universal tariff on all imports, along with a reciprocal tariff targeting dozens of countries. And some of those rates shot up to as high as 50%. Unsurprisingly, global market took a nosedive after the announcement. And shortly after, Trump hit pause and sort of, right? He announced a 90-day delay on most of the new tariff, but not for China. In fact, tariff on Chinese goods jumped dramatically to 145%. And China didn't sit back. They fired back by raising their tariff on US goods to 125%. Now, in May, after stacking on the steep tariff, US China finally hit the brakes. They agreed to 90-day rollback. US tariff on Chinese goods dropped to 30%, and China cut theirs on US goods to 10%. But not everything cooled off. Trump's broadest the tariff, including 10% universal tariff, and the reciprocal ones are tied up in court. Appeals court recently extended a pause on a ruling that Trump overstepped his authority. And arguments are set for July 31st. So those tariffs will likely stay in place for at least 2 more months. And no matter who loses, they expect to take it to the Supreme Court, which could drag things out even longer. So also, as of June 4th, Trump doubled the tariff on steel and aluminum from 25% to 50%. Now, just yesterday in London, US and Chinese negotiators agreed to a new framework to revive their trade truce. So basically builds on a deal they discussed in Switzerland the last month. The details are still on the wraps and need approval from both President Trump and Xi. It seems like President Trump approved it today. So there is still uncertainty ahead. Now, since Liberation Day, Trump trade policy has been a bit of roller coaster, on again and off again, right? But one thing has been steadily climbing: the effective U.S. tariff rate. That's the total tariff collected divided by the total value of all imported goods. And at the start of the year, that rate was pretty low, just 3.7%. Last year was like near 0%, almost like on a 2%. But after Liberation Day, it spiked to a 26.9%. And thanks to the recent 90-day pauses with the key trading partners like China, it has come back down to around 13.5%. Now, what's that mean for the economy? So according to a 2018 Federal Reserve model, back then, obviously, during Trump 1.0, the Trump imposed a tariff on Chinese and other imported goods. At the time, Federal Reserve ran a model. So based on that, every 1% increase in the effective tariff rate reduces GDP by 0.14% and raises prices by 0.09%. So based on that model, the current tariff could shrink US GDP by about 1.4% and add almost 1% to inflation over some time. On the revenue side, the US has pulled in close to about $70 billion from tariff so far this year. That is up 79% from the same time last year. The Congressional Budget Office, CBO, estimate that the tariff revenue could help reduce the federal deficit by $2.8 trillion over the next decade, over 10 years. But there's a catch. But a lot of studies out there suggest that the economic drag and supply chain disruptions and retaliation from other countries could cancel out much of that benefit. Now, let's move on to markets and commodities. In April, equity markets took a hit following broad tariff announcements, but they bounced back strongly in May, recovering much of the earlier losses. And what has been driving this rebound? And two key factors stand out. The first one is renewed optimism around US-China trade talks, especially with the possibility of easing restrictions on tech exports related to NVIDIA chips, right? AI chips. And number two is the surprisingly strong May jobs report announced last Friday, and coupled with the signs that inflation is stabilizing. And we got the new CPI print this morning. We're going to talk about it a little bit later. Thanks to this developments, equities have a climb back to near record highs. That said, the valuations are still quite elevated, and which means the market could be sensitive to any shift, whether it is changes in interest rate, trade negotiations, or economic growth data. The US Treasury market has seen quite a bit of volatility in 2025, driven by a mix of factors like Fed's monetary policy stance and broader economic outlook, trade developments, and fiscal concerns. On the short end of yield curve, as you can see on this slide, not much has changed. That's because the Fed has kept the Fed funds rate steady and taking more of a wait and see approach. In contrast, the midterm yields have moved lower, largely reflecting slow economic growth. Now, meanwhile, long-term yields have ticked up slightly as investors grow more concerned about the rising budget deficit and national debt. As you can see, the 20-year, 30 years shot up. Overall, Treasury yields continue to shift in response to changing market conditions and new economic data and investor sentiment. Now, the US dollar index, which measures the dollar's value against the basket of 6 major currencies, has dropped 8.6% year to date. So what is behind the decline? A few key factors at play. First, investors have been rebalancing their portfolios, so scaling back their heavy exposure to US assets. That's largely due to the expectation of a slowing US economy and lower anticipated returns. On top of that, the demand for the dollar is expected to decline as the Trump administration pushes to narrow the trade deficit. And finally, there are growing concerns about inflation risk tied to the rising federal budget deficit, which is also weighing on the dollar. And gold prices have soared this year, hitting $3,310 per ounce. That is 26% jump year to date and a 43% increase over the last 12 months. So what is driving this surge? A big part of it comes from rising demand by central banks, especially in the emerging markets like China and in India. They've been actively diversifying their reserves away from the US dollar, which has been weakening. On top of that, investors have been flocking to gold as a safe haven asset. And with ongoing trade tensions, tariff, and growing concerns about the US assets and inflation, gold has become a go-to asset recently for those looking to hedge against uncertainty. All right, so now oil and copper. So crude oil had a rocky start this year, WTI crude oil began January at around $76 per barrel, but slid to a 4-year low of nearly $60 by early April. That drop was mainly driven by fears around trade wars, new tariffs, and the increase of production from OPEC Plus. But things turned around in May and early June, and oil prices rebounded as the US-China reached a trade truce and resumed the negotiation, which boosted hopes for a stronger global demand. And copper also had a dramatic ride, and prices surged early in the year as buyers to secure supply ahead of potential 25% tariff on imported copper proposed by the Trump administration. Added to that, a tight supply and strong industrial demand, and prices climbed quickly. But after Liberation Day, copper prices took a hit, falling sharply because of concerns over slowing manufacturing activity and ongoing tariff uncertainty. They've since bounced back and climbing to nearly about $10,000 per ton. Now let's switch gears to economic growth. Now, the first quarter GDP show a 0.2% contraction, negative growth in economic growth, marking the first decline since the first quarter of 2022. Let's unpack this a little bit here. Now, the GDP contraction was mainly due to a 41.3% surge in imports. So imports are subtracted from GDP and driven by the businesses front-loading goods prior to the implementation of tariff. Also, surge in imports resulting in a substantial trade deficit. Now, consumer spending show growth, although it significantly slowed down to 1.2% from 4% in the prior quarter, and marking the lowest increase since the second quarter of 2023. Now, the surge in imports was partially offset by a significant increase in business investment. In other words, inventory, right? Why was business spending investment increased by 22%? It was because of some of the imports ended up in inventory, which saw significant increase, leading to the largest buildup since the fourth quarter of 2021. Now, so with everything going on, and how do we end up with a negative 0.2% GDP growth in the first quarter? To break it down, as you can see on the slide, you see the classic GDP equation. Some of you might remember this from your college econ classes. And GDP is made up of consumption, investment, government spending, and net exports, which exports minus imports. You can see this layout on the slide. Now, let's look at what actually drove the numbers. The consumer spending added a solid plus 0.8%. Private investment, even stronger, contributing plus 4%. But here's where things turned. The government spending pulled the GDP down slightly, negative 0.12%. The net exports were biggest to drag, subtracting negative 4.9%. So the net export number include 0.26% boost from export, but it was more than wiped out by negative 5.16% surge in imports. So even though the consumers and businesses were spending and investing, the trade imbalance and a dip in government spending tipped the scale into negative territory. Now, let's move on to employment. All right, last Tuesday, Bureau of Labor Statistics released April JOLT report, job openings and labor turnover survey. And just a quick heads up, this data is a bit dated, and because it tends to bounce around from month to month. So economists usually don't read too much into any single report about the job opening and labor turnover survey. That said, there were a few interesting takeaways. Job openings actually rose in April, which was a bit of a surprise. And hiring also picked up, suggesting that demand for work is still pretty solid, even with all the economic uncertainty out there. And we did see some declines in job openings in areas like discretionary services, like travel and leisure, and in manufacturing. But overall, labor market held steady, and the ratio of job openings to unemployed individuals, which Fed paid great attention to, is stay at 1.0, which is right in line with the pre-pandemic levels. Now, the number of layoffs, according to this Zolt survey, number of layoffs climbed to the highest since October, and a few people voluntarily quit their jobs, suggesting people are less confident in their ability to find a new employment opportunity out there. And the key highlight from last week was the non-farm payroll report announced last Friday. It looks like some of the Trump administration policies are starting to show up in the data. In May, businesses added about 139,000 new jobs, which was more than expected. Most of the gains came from the healthcare and social assistance and leisure and hospitality sectors. These two sectors have been pretty much main contributor to the new jobs for the almost several months. That's not good because it's concentrated in 2 or 3 sectors here. On the flip side, manufacturing, which is particularly sensitive to tariff, saw a slight decline. It is also worth noting that job numbers for April and March were revised down by a combined 95,000 jobs and pointing to a gradual cooling in overall job growth. This slowdown likely reflects rising business costs from tariff and a growing economic uncertainty. And one more thing to keep in mind, we've been seeing consistent downward revision in the new payroll figures lately, which is often a sign that economies are starting to slow down. Now, one area of job market that both investors and policymakers are watching closely is the federal government employment. It drew a lot of attention because of Doge with Elon Musk. So now in May, federal government cut 22,000 jobs, the largest monthly drop since 2020. That brings the total decline to 59,000 jobs since the start of the year. So what is also important to note is that around 75,000 federal employees are currently in the deferred resignation program, meaning that they're still receiving pay and benefit through September 30, 2025. These individuals won't show up in the layoff numbers until the end of September. Once that date passes, we could see a sharp spike in federal job losses. And looking ahead, economists are warning that up to 500,000 US jobs could be at risk as federal spending cuts ripple out to contractors, universities, and other organizations that depend on public funding. Now, unemployment rate. It was held steady at 4.2% in May, but not necessarily for the right reasons. Both employment and size of the labor force decline, which may reflect the impact of recent government policies, particularly around immigration and employment. In fact, the labor force shrank by the most since late 2023 that helped keep the jobless rate flat, even though more people are technically unemployed. So the steady unemployment rate isn't because the jobs are abundant, it's because fewer people are actively looking for work, which is not good. And we also saw a drop in the labor force participation rate, which fell to a 3 month low of 62.4%. Even among prime age workers, those between 25 and 54 years old, the participation rate declined, which is a bit concerning. Now, layoffs dipped slightly last month, but what really stood out was the sharp drop in the number of people voluntarily quitting their jobs, which is kind of in line with what we discussed earlier. That's often a sign that workers are feeling less confident about the job market. And also saw decline in temporary help services employment, which is often viewed as an early signal of where labor demand is heading. So that's another indicator suggesting some softening in the job market. Now, as for hours worked, the average weekly hours held steady at 34.3 hours in May, which matched the market expectations. But it is worth noting that this is still below the 10-year average of 34.5 hours. Wage growth picked up in May, and with average hourly earnings rising 0.4%, and following a 0.2% increase in April. And that was a bit stronger than expected. On a year-over-year basis, wages grew by 3.9%, which is in line with the April's pace and above both market expectation and a 10-year average of 3.7%. So while the job market may be cooling in some areas, wage growth is still holding up relatively well. Now, let's move on to consumer activity and confidence. And in April, bit outdated, but we'll get May numbers soon. In April, we saw retail sales take a bit of a breather after a strong surge in March. Consumers started pulling back, especially on big ticket and discretionary items like cars, sporting goods, and other non-essentials. So what's behind this slowdown? Well, a lot of earlier demand, particularly for things like automobile, was likely driven by concerns over potential tariff. So people rushed to buy before prices went up. But by April, that urgency faded, and so did the spending. So out of 13 retail categories tracked by the U.S. Census Bureau, 6 posted gains in April. Leading the way were food services and drinking places, up 1.2%, and the building materials, which rose 0.8%, and electronics and furniture and online sales also saw modest increases. And on the downside, sporting goods dropped 2.5%, and miscellaneous stores fell 2.1%. Department stores, gas stations, and clothing or saw declines and reversing gains from March. Now let's switch gears to consumer income and spending here. And personal income rose 0.8% in April, beating expectation and topping March's revised 0.7% gain. The increase was mainly driven by higher wages and business income and government benefits. And disposable income, what is left after taxes, also grew 0.8%, with both nominal and inflation-adjusted figures showing their strongest gain since January 2024. The real disposable income rose 0.7% for the second month in a row. Now, in April, consumer spending declined compared to March, especially on goods like cars, clothing, and recreational items. This pullback was partly expected as many consumers had front-loaded purchases in March to get ahead of the April tariff. So what's interesting is that this slowdown came despite strong income growth. So with the rising economic uncertainty, many consumers chose to hold back on spending and boost their savings instead, pushing the savings rate to its highest level in nearly a year. Now, let's talk about consumer confidence. And consumer confidence made a strong comeback in May, with the Conference Board's index jumping 12.3 points to 98, beating expectation and marking the biggest monthly gain in 4 years. This rebound follows April's nearly 5-year low and reflects broad improvements across all age, income, and political groups. Now, it's a good reminder that consumer sentiment tends to shift quickly in response to headline news. So in May, the presentation situation index of Conference Board rose to 135.9, reflecting improved views on current business conditions. However, the perception of job availability declined for the fifth straight month. The expectation index, as you can see on the slide, which looks at short-term outlook for income, business, and jobs, jumped to 17.4 points to 72.8, bouncing back from April's low. While that is solid improvement, it is still below the recession warning threshold of 80. So consumers were less pessimistic now about the economy, about the job market, and show renewed optimism about the future income. And with the stock market rebounding, more people now expect further gains over the next year. The tariffs remain a top concern, with the many citing rising prices and potential economic fallout. On a positive note, consumers felt better about their family financial outlook, and a few expect a recession in the next 12 months. And the spending plans also a little bit picked up. Now, in a recent special survey by the Conference Board, about 37% of consumers said they're setting aside money for future expenses, a sign that many are becoming more cautious with their finances. And at the same time, around 27% reported dipping into their saving to cover everyday costs and delaying major purchases. And interestingly, 19% said they made a purchase this early to avoid a potential tariff hikes. And that number jumped to 26% among households earning over $125,000. Now, this finding line up well with the consumer spending trend that we talked about earlier, and showing how tariffs and economic uncertainty are clearly shaping consumer behavior. Now, let's briefly discuss the small business sentiment. Now, small business optimism slipped again in April, with the index falling 1.6 points to 95.8. It's the lowest level since October and the fourth straight monthly decline. The decline was mainly driven by weaker expectation for business conditions and decline in unfilled job openings. Now, while most small business don't export, right? So many rely on imported goods for their operations. And those supply chains are now under pressure. Now, with the tariff policy shifting quickly, the costs are changing, and that's affecting nearly every business decision. Now, uncertainty remains high, as you can see on the slide here, which is making small business more cautious about spending, hiring, and investing. Now, uncertainty index is currently at 92, well above 51-year average of 68, well above, and even higher than the post-2016 average of 80. In April, 34% small business owners reported job openings they couldn't fill, slightly down from March. That's the lowest level we've seen since January 2021 during the COVID recession. And still 56% said they were hiring or trying to hire, which is up slightly from the previous months. On the investment side, the capital spending remains weak. Only 18% of small business plan to make capital outlays in the next 6 months. That's down from March. And that's the lowest reading since April 2020 at the start of the pandemic. Now, as for what is keeping small business owners up at night, the top 3 concerns are: first, the quality of available labor. Number 2 is taxes. Number 3 is inflation. Okay, let's now move on to inflation here. Okay, so, well, this CPI figures are for April. I know this morning the May numbers released, so it's kind of a little bit it's kind of outdated. But anyhow, the CPI Consumer Price Index in April came in softer than expected, and it rose by 0.2%. This morning, May figure came in at 0.1%, slightly lower than the April figure, and it is the and it's lower than market expectation with the 0.2%. But in April and May, I know I need more time to dive into the May numbers just announced this morning, and I promise you I'm going to provide that detailed analysis in my weekly update later this week. But in April, I'm pretty sure in May, shelter costs made up more than half of the increase. The prices fell in leisure categories like sporting events, airfares, and hotels. Hinting that the consumers may be cutting back on discretionary travel and entertainment. In April, food prices declined, but in May, I'm just reading off the announcement right here that food prices actually went up in May, and the energy price rose in April, but it down in May. So kind of food and energy prices very volatile from month to month. Now, they're looking at the bigger picture here now, right? The goods price stay kind of relatively flat, while service prices continue to climb. The stability in goods price might reflect the business absorbing tariff-related costs or selling off pre-tariff inventory. But as that inventory runs out, we may start see tariff impacts show up more clearly in the coming months, probably late summer. Now, if you remember, during Trump 1.0, during 2017 and 18 timeframe, when tariffs were imposed on imported goods, it took at least 3 to 4 months to show up on prices. So there's a lagging effect, 3 to 4 months lagging effect. Now, on an annual basis, CPI rose 2.3% in April. And now this morning, in May, it was 2.4%, pretty much kind of, similar to April. And then also, in April, that is slightly below the March and market expectations. And actually, the May number came in 2.4%, which is in line with the market expectation, but slightly exceed the April annual CPI figure. Now, the increase was almost entirely driven by services, with the shelter cost alone accounting for more than half of the annual gain. That said, shelter inflation has been gradually easing, as you can see here, and which could help take some pressure off the overall inflation in the months ahead. All right, so core CPI, once again, excluding food and energy, ticked up 0.2% in April. And this morning, it came in 0.1% lower than April. And on an annual basis, in April, the core CPI came in 2.8%, this morning, May annual core CPI came in 2.8%, which is the same as March, but it's came in a little bit higher than the market expectation. Actually, lower than market expectation of 2.9, which is it's good news. Now, PPI, the producer wholesale prices surprised to the downside in April. The posting biggest monthly drop in 5 years. And the main driver, the sharp fall in service prices, especially from a lower margin and wholesalers and retailers. This suggests that the business might be eating some of the higher tariff costs instead of passing them on to consumers. Both monthly annual figures came in below expectation, with the food and energy prices, wholesale prices, continue to ease. Core PPI dropped again. Year over year, core PPI rose 3.1%. That is down from March. Now, let's take a quick look at the PC inflation here. Inflation remained subdued in April and in line with the market expectations. Many businesses have yet to pass rising costs on to consumers, though retailers like a Walmart and Macy's have a signal upcoming price increases to protect their margins. Now, core PCE, this inflation measure is a Fed preferred inflation gauge. We pay as a consumers pay to CPI, but the Fed paying attention to core PCE more than CPI. And core PCE index rose 0.1% in April, matching both March's revised figure and a March expectation. On an annual basis, it came in 2.5%, right in line with the forecast, down from March. While annual headline PCE is nearing the Fed Reserve 2% target, which is discussed a little bit earlier, the core PCE here remains elevated at 2.5%. Now, let's move on to manufacturing productions. And the U.S. Census Bureau released its report on durable goods, items such as appliance, aircraft designed to last at least 3 years. Orders for durable goods are a leading indicator of a manufacturing activity. Now, bookings for all durable goods fell 6.3%, as you can see on the slide, because of the pullback in commercial aircraft orders. And orders for motor vehicle, electrical equipment, appliances, communications equipment, and primary metals all fell in April. And the report underscores a caution among businesses as they assess the outlook for demand and a focus on cost cutting as the result of Trump's trade policy. And companies are also awaiting clarity on tax legislations now being debated in the Senate right now, right? Now, the value of core capital goods orders, a less volatile proxy for investment in equipment that exclude aircraft and military hardware, decreased 1.3% last month, after upwardly revised 0.3% gain in March. Now, orders placed with the U.S. factories for business equipment declined in April by the most since October, suggesting diminishing appetite to invest amid uncertainty about the tariffs and tax policy. Now, let's talk about the ISM Manufacturing Service Index. So ISM releases 2 key indicators each month: ISM Manufacturing Index, ISM Services Index. These reports give us monthly insight into the health of our manufacturing service sectors based on survey from purchasing managers and executives. Now, let's start with the ISM manufacturing. In May, manufacturing activity contracted for the 3rd month in a row. And if you look at the chart on the right, you'll see the 8 components that make up the index. One standout was the supplier deliveries, which hit their highest level since June 2022. That suggests longer lead times and growing challenges for purchasing managers trying to source goods and materials. They're raising the risk of potential shortages. But there are some bright spots: new orders, employment, order backlogs. Now, on the trade front, Activity weakened significantly, export fell to 5-year low, and imports plunged to their lowest level in 16 years. Now, service sector activity, now this is big surprise, unexpectedly slipped into contraction in May for the first time since 2024, with ISM services index falling to 49.9. Since any reading below 50 signals contraction, this drop caught many by surprise. The decline was mainly driven by the weaker demand, slow business activity, and the impact of a higher tariff. And also at the same time, price paid for materials and services continued to climb. And supply delivery expanded for the sixth months in a row, pointing to a longer lead time as companies continue to adjusting their supply chains. Now let's move on to housing. Okay, existing home sales declined slightly in April, down 0.5% from March to an annualized rate of 4 million units, missing expectations. Regionally, the West dropped 3.9%, and compared to April 2024, a year ago, existing home sales are down 2%. The decline was largely driven by persistently high home prices, elevated mortgage rates, and historically low consumer confidence regarding the timing of purchases. Now, despite the slowdown in sales, median home price rose 1.8% year over year. However, in the West, compared to April 2024, median price edged down slightly to about $629,000. As I mentioned earlier, the rebound the existing home market has been pretty limited. Mortgage rates keep climbing. Consumer confidence has dropped to near record lows. And according to University of Michigan, the number of people who think it is a good time to buy a home is also close to all-time low. Now, in April, the number of unsold existing homes rose 9% to 1.45 million. That's still below the pre-pandemic norm of 1.9 million, but it is up over 20% from last year. So month supply of inventory, or how long it would take to sell all listed home at the current pace, climbed to 4.4 months. That is up from 4.0 in March, 3.5 a year ago. For context, 4 to 7 months supply is considered under balanced market. So while buyers now have more options and a bit more negotiating power, many are still hesitant due to economic uncertainty and job market concerns. In April, first-time buyers made up 34% home sales. That's a bit higher than March 32%, and that's also up from 33% a year ago. That's a good sign. And all cash deals accounting for 25% of sales. On average, homes sold in 29 days, faster than March 36 days, but little slower than 26-day average this time last year. And here's the latest interesting data for existing home sales here. Home price between 250 and 500,000 make up the biggest chunk of single-family home sales. Interestingly, the higher the price, the faster home tend to sell, regardless of the area. Now, unlike existing home sales, new home sales actually, home sales actually surprised to the upside in April, hitting their highest level, since February 2022. The big part of that jump came from a 7.5% downward revision to March's numbers, and plus, home builders have been sweetening the deal with the price cuts and buyer incentives, which helped boost the demand. Now, in April, median sales price for new home was $407,000, slightly down 2% a year ago. And inventory ticked up, which translates to 8.1 months supply at the current sales pace. And even though sales picked up, the outlook for new home market remains cautious, and high inventory level, elevated mortgage rate, and prices, and more competition from existing homes are keeping things in check. Now, let's shift gear to new housing starts. In April, we saw slight uptick overall, thanks mostly to an increase in multifamily construction, but that was offset by significant decline in the single-family starts, which fell to the lowest level since late July. The biggest hit came in the West, where single-family starts plunged nearly 19%. Now, let's look at the single-family versus multifamily housing starts in April. Single-family starts, which usually make up the bulk of new home construction, declined 2.1%. On the flip side, multifamily start jumped 11%. And that's which actually above the long-term average of 367,000 units. Regionally, West experienced decline of 16%. Looking at the year-over-year picture, total housing starts were down. That includes 12% drop in single-family starts, while multifamily starts surged nearly 29%. Now let's talk about the building permits, which give us the glimpse of the future construction activity. Now, in April, permits dropped to an annual rate of 1.4 million units. That's the lowest level since May 2024. It also came in below the revised March figure of 1.48 million and below the market expectation. Regionally, West posted a gain in the building permit of 3.4%. The building permit drop for both single-family and multifamily in April, hinting at a possible slowdown in new construction ahead. And this continued weakness in single-family starts and permits really highlight the challenges the housing market is facing. And the high mortgage rate, steep home prices, 17-year high, and new home supply are still putting pressure on demand. And on top of that, builders are bracing for higher construction costs because of the new tariff, which makes them even less likely to ramp up production. So overall, the outlook for home building this year remains pretty subdued. Now, rate cut, move on to rate cut expectation economic forecast. This is my last section. So on the rate cut expectation front, no rate cut is anticipated at the June FOMC meeting next week. And market projects 77% chance of 1.25% rate cut and 100% chance of 1.25% cut in 2025. The first 0.25% cut is expected at September meeting with a 68% probability, which is considered a 50-50 chance. However, the market anticipates about 100% of a chance of the 1.25% cut in October. Now, I'm going to talk about the 2026 rate expectation a little bit later. And so let's take a look at what Wall Street economists are forecasting for the economy. So this is based on the survey of 81 Wall Street investment bank and commercial bank economists, right? They are expecting GDP to bounce back in the second quarter and growing by about 1.4% after a slight dip of 0.2% in the first quarter. That rebound mostly thanks to a drop in imports, but things might get a bit bumpier after that. With the new tariff kicking in, economists are predicting GDP could take a hit in the third quarter before gradually picking up again in 2026. Now, those same tariffs are also expected to push inflation higher in the second half of the year, especially in Q3 and Q4. The good news, inflation is projected to ease off gradually as we move into 2026. Now, when it comes to housing, economists think we are going to see existing home sales level off for the rest of 2025. No big jumps, no big drop, just a holding steady. But looking ahead 2026, they're expecting a bit of a lift, around 5% increase, and then things should settle back to that level, that new level. Now, on a more positive note, building permits are showing a steady upward trend. Economists expect them to keep rising through the rest of this year and into early 2026. After that, they are likely level off. But the momentum we're seeing now is a kind of good sign for the future, the construction activity here. And when it comes to the job market, economists are expecting a slow and steady rise in unemployment, reaching about 4.5% by the end of this year. and holding around that level through 2026. This uptick is mostly tied to the broader economic slowdown. Along the same line, businesses are expected to pull back on hiring in 25, creating a fewer new jobs, but there is a silver lining. Job growth is projected to gradually pick up again in 26, with the things looking much healthier by the third quarter of that year. Now, let's talk about the interest rate. Economists are expecting both the Fed fund rate and 10-year Treasury yield to gradually decline over the forecast period. Now, you might notice that this forecast looks a little bit different from the rate cut expectation we talked about earlier. That's because this particular projection is based on slightly kind of old data. I'm talking about a couple of weeks. So while the general trend still holds, just keep in mind there's a bit of a timing difference between the two there. Now let's talk about where economists stand on the chances of U.S. recession. Right now, the average consensus of the Wall Street puts the probability at around 40%. Now, if we rewind a bit back in the second quarter of 23, recession fears were much higher. That's when the Fed wrap up its aggressive rate hikes, pushing interest rate up to 5.5%. At that point, recession odds spiked to 65%. But after that peak, things started to cool off. The probability gradually dropped, but hitting a low of about 20% earlier this year. However, following Liberation Day, we've seen those concerns creep back up again, bring us to current 40% mark. Now, here's the key takeaways, my last slide here. Now, consumers, even though income growth remains strong, many consumers are pulling back on spending and choosing to save more, largely because of the ongoing economic uncertainty. And consumer confidence did bounce back in May, but it's still sitting at historically low levels. For businesses are playing it safe. With so much uncertainty, they're being cautious about spending, hiring, layoffs, and investment decisions. They're also closely watching how demand evolves, especially in light of recent trade policies and pending tax legislation in Congress. Interestingly, service sector activities declined into contraction in May, the first time we've seen that since June 2024. That is one big concern. Now, labor market, we're still seeing healthy job growth, but it is happening at a slow pace. Now, revision to a previous month's job number suggests the economy is starting to cool down. The unemployment rate has held steady, but that is partly because of both employment and labor force participation have declined. Those are not good reasons. Looking ahead, unemployment rate is expected to rise this year and next. That said, wage growth is still holding up fairly well, which is a positive sign. And for inflation interest rate, goods prices have stayed relatively flat while service prices continue to climb. This could mean businesses are absorbing tariff-related costs or selling off older inventory. But once that inventory runs out, we might start seeing more noticeable price increase. Note that once again, 3-4 months of a lagging effect on the prices. And retailers now warning that there will be some price hikes, and tariffs are expected to push inflation higher in the second half of the year, with some relief are likely in 2026. Fed is in wait and see mode, watching how trade policy play out. And now housing, we are expecting a big rebound in home sales anytime soon. High price, elevated mortgage rate, low consumer confidence are keeping buyers on the sideline. However, inventory is rising, which gives buyers more options, negotiating power, putting downward pressure on prices. In the short term, housing market looks subdued, but over time, as mortgage rate prices ease and confidence improves, we could see a gradual recovery. Now, this concludes my presentation, and I cover a lot of ground. And I really wanted to provide, more insight, more data to you today. But seems like we're running out of time, so I'm going to stop here. Ash, back to you.
Yeah. So thank you very much, Mark. Extremely valuable information. Obviously, it's a lot of dense information. We understand that. I'm hoping that the participants today got a good view of what the economy is and where it's headed from a banker's point of view, at least from CBC's point of view. This is merely the data that we have and the interpretation of Mark using the data and putting our personal opinions to it. So hopefully all of you found tremendous value. I think there's a Q&A session that you can respond to. I think one of the questions that came up is, are we going to share this? We're happy to. I think we have email so we can share this with anybody that wants to have a copy of it. I want to say thank you very much for Mark for his hard work to put this in, and thank you very much for all the participants. We have many customers here. Time is the most valuable thing you guys have, and allowing us to share 1 hour of your time with us and our time with you, most critical. That hopefully this is one of many values that we can bring to the table. However, there's individual customers that have individual questions. Please send it to Mark and or I. There's a Q&A on here, and if not, most people have our emails and your RMs and your RVPs that invited you. Those people can also receive the questions and escalate them to Mark and or I, and then we can provide personalized responses to each one of them. We can also do this for your customers. If anybody feels like you have a constituency within your company that could benefit this, then we can customize it for you, for your application as well. These are little things the bank does in terms of adding value to your banking relationship with us. So I'll open it for a few questions. Remove the mute button if there is any. This thing has you can raise your hand. If there's none or any, then we will give your time back, and have a good day. Have a great afternoon, and thank you very, very much for your time. It's very much valued and appreciated, the time you spent with us. I will leave it open for a few more minutes and then give you guys your time back. Thank you so much. Yeah, I think we got a couple of questions in. That's what Sanjay is saying. So, Mark, can you see the questions? You want to open them up, or you want to just respond to them later? What are the questions, Sanjay?
We do see a couple. Yes, we do see a couple questions here.
Okay.
Do you see any possible black swan events on the horizon? If so, what? Well, actually, we don't see any immediate downturn in economy anytime soon. And obviously, the tariff, this trade war, is basically it seems like it's going to get stabilized, for the next 2-3 months. We know the first 90-day pause will expire early July, and it seems like the trade talk with China is going well. So, but once again, so still there are some moving parts, and we need to continue to monitor this uncertainty around the trade war right now, and we don't know how the trade talk with the Japan, South Korea, and other countries going to play out. So it's very fluid, and we don't see any particular black swan events. It's going to trigger any kind of recession anytime soon yet. But obviously, we need to closely monitor the situation for the next 2-3 months. And then I do see some other questions, but in the interest of time, we'll definitely get back to you, and we're going to provide our responses either, I think, through email.
All right.
Back to you, Ash.
Yeah, if there's any other questions, if there are some critical ones and simple ones, we can answer them, or we will respond back. If there's easy ones, Mark, we can use a couple more minutes. It's 11:05. If they're dense questions, then we can always respond to them. If we know the name and the email addresses, we can. For the benefit of the rest of the group, can you read the questions so that we know that other people have questions similar but are not courageous enough to ask it? So if it's a question that can benefit the group, then let's just address them, since we have 60 more people still here.
Yeah, Ash, I think one more question. I think you already addressed about the copy of this stack. Yes, obviously we're going to share this stack. And then the last one, the question I'm seeing here is about the federal government spending its possible effect. Yes, we'll get you more information, and then we want to dig in more data for the federal government spending is effect. That we could do that for you, and we'll get we'll send it over to you as soon as possible. Okay.
Got it. Okay.
That's all the question that I see here.
All right. Well, those are the only ones, and we'll sign off. Thank you very much. Appreciate all of your guys' time.
Thank you.